Welcome back. The Reserve Bank has just put the minutes of the monetary policy on the website. It's out in the open. It does look like the Reserve Bank members, the Governor Shaktikanta Das himself and Michael Patra, and to some extent even Rajiv Ranjan, are way more cautious about inflation. The external members a little more benign, a little more confident that the time has come to reduce the real rate, which is the difference between the interest rate that you and I paid, the nominal rate minus inflation. At 200 basis points, Dr. Verma thinks it can endanger growth. But I have the external members with me. I've been speaking with Ashima Goyal, Jayant Verma and Shashanka Bide. Gentlemen and Ashima, thank you for your patience. Dr. Bide, how confident are you of growth continuing at this pace?
Well, I think not all the engines are firing. So, particularly, I think as far as private consumption is concerned, even Q2, I think, has not been particularly high. And so I think sustaining this growth will require certainly favorable external conditions. And I think sustaining the investment demand. Investment demand also has been sort of, supported by high government spending on capital expenditures. So as far as sustaining the high rates of growth, I mean, looking at these trends, it has some vulnerabilities going forward.
Okay. Oh, has some vulnerabilities. Ashima, on that point, do you think that a rate cut needs to be advanced in the sense that, next year, the expectation is that global factors will cloud growth, as well as the government can't go on doing this kind of capex. This time it is a 9% fiscal deficit. You can't continue that. So government capex may have to slow down in the in the 2024 budget. Therefore, would you want a rate cut maybe by mid 24 in the least?
See, I think one of the strengths of monetary policy over the last few months has been that we've kept real rates near equilibrium, whether it's the real interest rate or the real exchange rate for that matter. And this has really helped, induce the correct behavior, because we want to balance the real rate between, we want savings to grow, but we want investment also to rise. Right? So if the rate is near equilibrium, and our estimate of the equilibrium real rate is 1.5, so it can be around that, but it should not exceed that too much. So this is what stimulates growth, that prevents overheating and does not squash growth, right? That is the idea of equilibrium. So that is why I think it is important to keep that real rate in mind and prevent it becoming too high. This is what happened in 2018, for example, when oil prices fell and inflation was falling severely and rates were not cut. So we should not repeat that mistake. So we need to be very careful because it is forward-looking. Okay. A high real rate today will damp growth down the road.
Yeah. You are echoing what Dr. Verma has also written in terms of real rate. But, Dr. Verma, we speak to corporates day in and day out. No one is complaining that interest rate is breaking their back. I mean, very few are even borrowing. Most of them are with, internal generation of profits. So it's not as if interest rate is a game breaker at this point in time. Then why this plea on your part that, sooner rather than later in terms of softer rates?
To whom was that question?
To you, Dr. Verma.
Okay. You see, I think, as Ashima mentioned, monetary policy is always forward-looking. You cannot do monetary policy by looking at the rearview mirror. Okay, so today the real interest rate does not appear high, because if you look at today's inflation and today's interest rate, the real interest rate is not looking very high, and therefore people are not crying about it. The point is that as we move forward, and the interest rates, the inflation rate starts coming down, that is when the real interest rate perks up. And we have to be forward-looking. We have to look at everything in terms of projected inflation. That is when the number looks scary. The number looks scary when you look out through the windscreen. If you look out through the rear view mirror, everything looks fine. So we have to be very, very careful about which direction are we looking at. Are we driving with eyes on the rearview mirror, or are we looking out through the windscreen? If you look out through the windscreen, you can see real interest rates rising very, very rapidly. And that is obviously a dangerous thing for the economy. And, as, you know, the arguments that you made, you know, also, you know, that the fiscal consolidation is going to
Yes,
come in.
yes.
There would be a growth slowdown through that. We have to respond to all of that, you know.
Okay.
And therefore, I think we have to be extremely wary about high real interest rates.
Yeah, I agree. But, you know, I did not mention the other point that we are going to get included in the bond index. That will also mean that there will be more of a downward pressure on term premium, on yields, one expects, because there is going to be one big buyer of about $25 billion of Indian GSECs. So there, you know, there is also perhaps that as a positive for growth. But be that as it may, Dr. Bhide, I don't want to ask Verma this question because he's always been against stance as a very concept. How would you think the stance should change? What should be the next stance? Should it be neutral, and how far out is it?
As I said, you know, I guess priority certainly is to get the inflation rate closer to the target. And therefore, I think the stance has to be consistent with that. As I said, you know, I guess Q1 of 24-25. So I think maybe that is the projection. So if the sort of business as usual projections get us to 4.5% or less, I think, on consistent basis, then I think there is a case for a change in the stance.
Okay. Well, Fed dot plot is forecasting 3 cuts in calendar 2024. So that's why I'm asking you. You're expecting a stance change, Ashima, early next year?
You know, I think when we keep emphasizing data dependence, it means the stance is less important.
Okay.
You know, because market have to infer looking at the data. The Fed also, if you see in September, their projections were for no cuts, and now there are 3 cuts because inflation has fallen.
Yeah.
So keep an eye on inflation, and you will see the stance change if inflation
Fair point.
falls.
You know, for
And
the
I just want to make a point
sure.
about your corporates not worried about the interest rate. You know, corporates don't see the second round. That is that consumer household purchases of durable goods, of housing, real estate. Yeah, all that depends on loan rates, and that affects their demand.
That's true.
Yeah.
No, fair
And so
part, of course.
there is an impact of real interest rates on their demand and therefore their investment plans, even if it's not financing because they have more surplus.
That's right. Okay, I'm getting warned that I'm out of time. Can I just expect a monosyllabic answer from each of you in terms of an estimate for next year? Ashima, you go first. What kind of a GDP growth rate next year do you think you will work with? FY25.
7% is fine.
Okay. Dr. Verma, next year?
I think the RBI estimates appear reasonable to me.
6.5? Okay. Dr. Bhide?
Yeah, I think I'll also go with 6.5.
Okay. Thank you very much, Dr. Bhide, Dr. Verma, and Dr. Goyal, for enhancing our understanding of the economy and for your comments on the minutes. With that, we wrap up this special show. But don't go anywhere. News continues on the other side.